All right, let's dive in. We've got a stack of sources here, research, articles, your notes, and they're all pointing towards some uh, pretty choppy waters in the market lately. What we want to do in this deep dive is really navigate that for you, understand these conflicting signals, and figure out what this sudden shift actually means, especially looking at the next, say, 24 to 48 hours.
Exactly. And this isn't just your standard market update. Something pretty major just happened, a new development that basically flipped the script overnight. It really forces us to reassess everything we thought based on the older data. So yeah, the mission here is to cut through all that noise in the material and find what's really important, what's actionable for you right now.
Okay, so let's set the scene first. Before this bombshell hit, what was the landscape looking like? What were the sources telling us about the market's mood?
Well, the sourcing painted a picture of cautious optimism, I'd say. We were coming off a really strong Q1 earnings season.
Right.
Yeah, something like 78% of S&P 500 companies beat expectations, and growth was solid, around 12.9%.
Yeah.
And on inflation, well, things seem to be, moderating. The Q1 core PCE number, that's the Fed's preferred gauge, right?
Right.
It actually got revised lower, down to 3.4%.
So some positive signs there.
Yeah.
And what about the Fed itself in that context? Where were they at?
According to the May FOMC minutes, and this is key, this was before the latest news, they were definitely in a wait-and-see mode.
Okay.
They even specifically mentioned trade uncertainty as something they were keeping an eye on. So there was some hope building for maybe a September rate cut. Market was pricing in, about a 45% chance? That was the baseline.
And here's where that baseline just gets shattered. Tell us about the critical piece of news that came out May 29th to May 30th.
Yeah, this is the big one. A U.S. federal appeals court temporarily reinstated Trump's global tariffs.
Whoa.
Yeah. It overruled a lower court decision that had blocked them. Now, the White House has until June 9th to make its case. This is the source of that major whiplash we're seeing.
Okay, that phrase, policy whiplash. Why does this ruling cause such a violent reaction? It's just tariffs coming back, isn't it? Or is it more than that?
Well, it is more than that. What's really fascinating and damaging is the instability it signals.
Yeah.
It's not just the direct economic hit from the tariffs, which, yeah, that's significant. But it's the fact that a major policy like this can be on, then off by one court, then suddenly back on again by another court, all pretty quickly.
Right.
For businesses trying to plan supply chains, years ahead, for investors trying to figure out future earnings, that level of uncertainty is just toxic. It jacks up the risk premium investors demand. The sources even mentioned this kind of throws cold water on what some analysts called the taco trade.
The taco trade.
Yeah, the idea that Trump always chickens out from the most extreme trade stuff. Well, that assumption looks pretty shaky right now.
Okay, so that assumption's under scrutiny. And how does this new tariff bomb feed back into that Fed picture? The wait-and-see mode.
Oh, it completely reinforces their caution. I mean, it pretty much takes a near-term rate cut off the table, and it seriously bumps up the risk of stagflation.
Stagflation, high inflation, slow growth, nasty mix.
Exactly. Tariffs push inflation up, right? Import costs rise. So the Fed needs really clear, solid evidence on how this whole thing is actually hitting the economy before they'd even think about easing policy. This court ruling just muddies the waters completely, makes getting that clear data much harder, pushes any potential cut way further out.
So, okay, we got some economic data around the same time, May 29th, 30th. Q1 GDP revised slightly better. That core PCE revised lower. How do we even interpret that data now in light of the tariffs?
Well, yeah, that PCE data looks kind of dovish on its own, right? But the overwhelming forward-looking factor now is the tariff uncertainty. That's what's driving the market mood.
Okay.
And look at some other data points from the sources that came out then. Jobless claims actually jumped up to a 3.5-year high. 340,000. Yeah, suggests maybe some weakening in the labor market. And pending home sales dropped sharply, down 6.3% in April. So fundamentally, it's a pretty mixed bag. But this unpredictable risk from the tariff news, that's the headline dominating everything.
And what about that strong Q1 earnings picture we started with? Does that still count for anything?
Well, it times for history, for Q1 performance. But for the forward outlook, it's getting overshadowed, definitely. Companies are probably going to be way more cautious in their Q2 guidance.
Makes sense.
I mean, look at Nvidia. Yeah, amazing quarter, blowout numbers. But even they had already flagged an $8 billion hit for Q2 just from the existing China export controls.
Right.
Now, they and tons of other companies with these complex global operations face this additional layer of broader global tariffs messing with supply chains, potentially hurting demand way beyond just China.
Okay, let's try and crystallize this shift. What are the absolute key takeaways from the sources confirming this new, more nervous landscape?
Number one, clearly the appeals court reinstating the tariffs. That's the catalyst.
Right.
Then the immediate market reaction tells the story. Negative sentiment, futures pointing lower, Asian markets taking a tumble, reports of Apple supplier stocks dropping. It shows how fast and hard this hit.
Okay.
And finally, those Fed minutes we mentioned. Released just before the ruling, they confirmed the Fed was already worried about trade. Now, that concern looks, well, pretty prescient, and it's amplified by this ruling.
Okay, so that's the setup. Let's unpack what the source material suggests might happen next. It lays out 3 potential scenarios, right?
That's right. Based on the analysis and the sources, the highest probability, around 65%, is for a sustained hawkish tariff stance. Basically, the tariffs stick around, uncertainty remains high.
Okay, 65% hawkish. What else?
Then there's a 25% chance of tariff de-escalation, maybe some political deal, or another court steps in, things cool off a bit, and only a 10% chance of rapid escalation, like a full-blown trade war scenario.
All right, focusing on that most likely one, the 65% hawkish scenario, what does that actually look like for the market, according to the sources?
It probably means more volatility. The VIX index, the fear gauge, likely moves higher. Major indices, they'll probably face downward pressure or maybe just get stuck in a trading range.
Right.
And you'll likely see that rotation we've already started seeing. It'll probably accelerate. Money moving out of sectors sensitive to global trade and consumer spending, think tech, industrials, consumer discretionary, and into more defensive areas.
Like utilities, staples.
Exactly. Utilities, consumer staples, maybe healthcare, a flight to safety. Although, interestingly, even the U.S. dollar's role as a safe haven is a bit uncertain here, given how global this tariff issue is.
Yeah, that's interesting. And it puts the year-to-date performance in perspective, doesn't it? S&P up over 11%, Nasdaq over 13%. A lot of that driven by tech momentum before this news. This really does confirm that rotation that was kind of starting in Q1 away from just pure momentum towards things like energy, low volatility stocks.
Yeah.
This tariff news just slams the accelerator on that trend.
It absolutely does. And what's really fascinating here, maybe the aha moment for you listening, is just how fast the market's focus can pivot.
Yeah.
You can have months of data showing strong earnings or inflation cooling off, but then one sudden unpredictable policy move can just override all of that because it injects massive uncertainty about the future. This tariff ruling is a textbook example, macro risk just trumping micro fundamentals in the short term.
Speaking of those micro fundamentals getting challenged, let's do that deep dive into some specific stocks your sources highlight. We're looking at Nvidia, AAPL, CAR, OC, and X. Chosen because, well, they're right in the crosshairs of this tariff story and have recent earnings news. Let's kick off with Nvidia, NVIDIA, everyone knows the name, the AI powerhouse. Q1 earnings were, frankly, stunning. $44 billion revenue, huge EPS beat, 69% growth year over year, just wow.
Absolutely dominant, no question. But the sources really highlight their known vulnerability, right? That $8 billion Q2 revenue hit they already flagged from China export control.
Well, that was already baked in, sort of.
Yeah, sort of. But what's new and what's critical now is how these broad global tariffs add this whole other layer of complexity. Nvidia's supply chain is incredibly intricate. It spans the globe. It's not just about final sales to China. Tariffs disrupting the flow of components from anywhere could hit their production, their costs, even the rollout of future chips like Blackwell.
Okay, so it's deeper than just sales figures.
Much deeper. And the sentiment chain for NVDA, it's been a roller coaster. You had the earnings high, right? Then the China controls brought it down a notch. CEO Jensen Huang's long-term vision kept the bulls going. But now, these new global tariffs inject this very real fear and uncertainty. It risks just completely overshadowing those great earnings, at least for now. Analysts are scrambling to redo their models, and you see it online, the AI bulls shouting, buy the dip, clashing head-on with the macro bears just pointing at this new tariff risk. It's a sharp confrontation.
Yeah, and you can feel that tension. What about the technicals and the quant data for Nvidia, according to the sources?
Well, it was already looking stretched, really overbought. RSI way above 70. And while some indicators like MEXCD were bullish, others like on balance volume were showing some negative divergence, suggesting maybe the price surge wasn't fully supported by buying volume.
Interesting.
Yeah. And post-earnings, sure, there was heavy call option buying, but you also saw a big IV crush, implied volatility dropping starkly. Often means the easy money's gone. And crucially, institutions were actually net sellers in the last quarter, even before this tariff news hit.
Yeah.
The AI simulation mentioned in the source material, it apparently predicted automated systems would start selling on tariff keywords, clashing with that retail buy the dip crowd, while institutions pull back and reassess just how much exposure they want.
So, bottom line for Nvidia right now.
The fundamentals are undeniably strong long term, but right now they're running smack into very overbought technicals and this huge, unpredictable macro headwind from tariffs. Short term. The risk definitely seems skewed to the downside until there's some clarity on this tariff situation.
Okay, let's move to Apple, AAPL. Why is Apple always so hypersensitive to this kind of news?
Oh, it's the supply chain. One word, China. But more broadly, as the sources stress, Apple's got this incredibly vast, deeply integrated global manufacturing machine. And yeah, it relies heavily on China.
Right.
Their last earnings report, Q2, was kind of mixed. Services looked good, but there were concerns about iPhone sales, and the stocks actually lagged behind a lot of its tech peers this year already.
Okay, so some pre-existing concerns. How do the new tariffs hit them specifically?
What's really crucial here is that these new reinstated global tariffs, they basically reactivate and crank up the volume on that previous threat of a specific 25% tariff on iPhones if they aren't made stateside.
Oh, okay. That specific threat comes back.
It feels much more real now with this court ruling. Whether it's that specific tariff or just broader ones hitting their components in assembly, it's a direct, very negative potential catalyst for Apple.
And how does that play out in terms of sentiment, market reaction?
Well, the sentiment chain looks pretty immediate and negative, according to the sources. New tariffs spark strong fear, right? Major concerns about profitability, about supply chain chaos.
Yeah.
So you'd anticipate heavy selling pressure. Reports of their Asian supplier stocks falling already. That just underlines the fear. The market expects margin pressure for Apple, disruptions. Maybe they have to hike iPhone prices globally, which then risks hitting demand hard.
Okay, what about Apple's technicals, quant data? Were they weak already?
Yeah, the technical picture was leaning bearish even before this news hit. Man-CD was negative, key moving averages were looking weak, short interest is actually low, but, news like this could change that fast.
Right.
There's a lot of options activity, puts and calls, clustered around that $200 mark, so that's a key level to watch. And like Nvidia, institutions were showing significant net outflows recently. There's also noticeable off-exchange short volume. The AI simulation, it reportedly flagged immediate alarm bells for Apple, expecting intense focus on how fast they can diversify manufacturing away from China and how they handle that tough choice. Protect margins by raising prices or protect demand by absorbing costs.
So the verdict on Apple?
Long-term, Apple's Apple, they're resilient. But right now,
Yeah.
immediately, highly vulnerable. This tariff exposure hits them directly, and the negative sentiment could lead to significant selling pressure. The technicals were already weak. This just adds fuel to the fire.
Okay, let's shift gears a bit. Industrials. Carrier Global, CARR. Big global footprint. They had a strong Q1, beat estimates, raised guidance, and crucially, they specifically said they were fully mitigating the impact of tariffs already in effect.
Right, and that's exactly why these new reinstated global tariffs are such a direct test of that claim.
Ah, okay. Puts their feet to the fire.
Exactly. The big question now is, are those mitigation strategies they had in place for the old tariffs enough to handle these new ones?
Okay.
Which might be broader or maybe more severe. That's the uncertainty.
So how does the sentiment chain look for GALE-RR?
Well, it went from positive after Q1 good earnings, that reassuring mitigation comment, stocks surged straight into, well, uncertainty and doubt because of the new tariffs, so you'd anticipate pressure.
Right.
And the ripple effect is important here. If a well-run global industrial-like carrier struggles with this, what does that signal for others? Or maybe they do handle it well and become a relative safe haven. It's interesting, too, the sources mention significant bearish bets, put options being placed on SCARR even before this, suggesting maybe some skepticism was already out there about headwinds.
Okay. Technicals and quants for Carrier.
It had gotten near overbought after that Q1 pop, probably more neutral now. The overall trading view signal, based on moving averages, was still buy just before the tariff news. Short interest was moderate, some active off-exchange shorting, high institutional ownership, but again, like the others, recent net outflow. The AI simulation apparently zeroed in on that mitigation claim, questioning if it covers these specific new tariffs, scrutinizing their global sourcing, looking for any new commentary from the company.
So overall assessment for Carrier.
Strong Q1 gives them a decent baseline fundamentally, but these new tariffs, they're a major wild card, directly challenging those earlier assurances. That put positioning hints the market might be skeptical. How the stock actually trades on this news is going to be really telling.
All right, similar vein perhaps. Owens Corning,
Yeah.
OC, building products,
Right.
also had a solid Q1, and they were also pretty specific about tariffs, weren't they?
They were, yeah, very specific. They talked about having a $50 million gross tariff exposure, but mitigating it down to just a $10 million net impact, mostly hitting their doors business.
Right.
That kind of proactive communication usually goes down well.
Right. Sounds like they were on top of it.
But again, the new tariffs challenge that narrative. The uncertainty is, do these tariffs fall outside the scope of that $50 million they already managed? Could they hit their bigger segments, like roofing or insulation, this time?
Makes sense. Sentiment for OC, following a similar path.
Pretty much. Solid Q1, that specific mitigation talk, led to some cautious optimism. Then the new tariffs hit, bringing back concern, uncertainty, anticipated pressure. And like Carrier, if they struggle, it could be a negative signal for the whole building materials sector.
Technicals and quants for Owens Corning.
Actually, the stock was already looking a bit bearish before this tariff news. It was in a falling trend, and MECD gave a sell signal. RSI was neutral, though. Short interest was low, but again, active off-exchange shorting noted. They have a share buyback program, which is usually a positive, but the big question is how institutions react to this new tariff wrinkle.
Okay.
The AI simulation reportedly recalled that Q1 commentary, but immediately started asking, does the old plan cover this wave? Examining their raw material sources, and also considering the demand impact if tariffs cause a broader economic slowdown that hits construction.
So overall OC assessment.
Looks like they were proactive managing the last round of tariffs. But these new ones create fresh uncertainty. The stock was already trending down. It really hinges on whether their existing playbook is good enough for this new challenge.
Okay, last one.
Mm-hmm.
They're always interesting, often volatile. United States Steel.
Yeah.
X. Classic trade policy play. Stock was up over 50% year to date, partly on political wins around the Nippon Steel deal.
Yeah, and this is where the tariff news gets really complex, creating that sharp confrontation of ideas we talked about. It's ambiguous for steel.
How so?
Well, on one hand, you could argue these tariffs are protective for domestic producers like U.S. Steel, limits foreign competition. That's the bull case, right? It boosts domestic prices.
Right.
But on the other hand, if these tariffs trigger a broader economic slowdown, that could crush demand for steel from key sectors like construction, autos. That's the bear case.
Yeah.
Demand destruction.
Right, protectionism versus recession.
Exactly. Throw in the fact they posted a net loss in Q1 and have significant short interest. It's a recipe for extreme volatility. And while the Section 232 steel tariffs are technically separate, this general shift in the trade policy environment, the willingness to use tariffs, is highly relevant.
So the sentiment chain for X is just chaos.
Pretty much ambiguity and intense speculation. Potential excitement about protectionism clashing directly with fear of demand destruction. You'd expect really wild price swings. And adding fuel to that fire. The sources noted absolutely massive, unusual call option activity on May 27th, like 144,000 contracts, up 99%. That screams intense bullish speculation, greed, maybe FOMO, betting on a positive tariff outcome, or maybe a massive short squeeze.
Wow, okay, technicals and quants for X. Sounds like a mixed bag, too.
Definitely. Strong uptrend recently, bullish MECD, but it was extremely overbought. RSI hit 85. That's screaming for a pullback, regardless of the news.
85, yeah, that's high.
It's very high. The high short interest absolutely makes it a squeeze candidate if the bulls get control. And that huge call buying confirms the speculative fever, the AI simulation. It was reportedly trying to weigh the protectionism angle against the recession fear, analyzing how that high short interest could amplify moves either way, and factoring in the distorting effect of that massive option speculation.
So overall take on U.S. Steel.
Highly speculative, period. Technically, it's dangerously overbought. Fundamentally, they lost money in Q1. But UT, you have these potential powerful upside catalysts, tariffs interpreted positively, plus that short squeeze risk amplified by options. It's likely to be incredibly volatile. Trading it hinges entirely on how the market decides to interpret the net impact of these tariffs on steel versus the broader economy. It's a real gamble.
Okay, so we've laid out this core conflict across the board, haven't we? Strong Q1 results, some positive company stories, running headfirst into this new macro fear driven by tariffs, bullish technicals hitting overbought warnings, companies saying we got this, now facing a new uncertainty. How do we, based on the source material, try to resolve these conflicts? How do we figure out what dominates, especially for the next day or two?
You really have to weigh the signals and, crucially, prioritize the most recent and most impactful information. The sources are pretty unequivocal on this. The reinstated global tariffs are the dominant new factor. They inject a level of uncertainty and potential negativity that just overrides the backward-looking stuff like Q1 earnings or older economic data. This policy shift fundamentally disrupts the market's forward-looking view.
Okay, so prioritize the new tariff shock.
Exactly. So let's apply that to resolve the key conflicts based on the source analysis.
Okay.
For Nvidia, conflict is awesome Q1 AI story versus overbought China issues no W tariffs hitting supply chains demand. Resolution. Tariffs are the big macro shock. Combine that with overbought levels, pullback risk goes way up, so the bias leans bearish tilt correction. Confidence, medium high.
Okay. Makes sense. Market overall.
Overall market. Conflict is dovish Q1 PCE, strong Q1 earnings versus no W tariffs. Inflation, stagflation fears. Weakening jobs housing data. Resolution. Tariffs are more current, highly uncertain, and forward-looking. They're a new significant headwind. Bias. Bearish risk off. Confidence. High.
Got it. Apple.
AAPL. Conflict of strong services. Some buy ratings versus weak iPhone trends. Bearish techs. No W direct tariff sensitivity. Resolution. Tariffs are a direct major hit, amplifying existing weaknesses. Impact feels immediate. Bias. Strongly bearish. Confidence. High.
And the trickiest one, U.S. steel.
U.S. Steel, X, conflict is strong trend bullish MCD, huge call volume potential tariff beneficiary versus extreme overbought Q1 loss economic slowdown risk hitting demand. Resolution, this is the most ambiguous one. Upside from protectionism versus downside from recession risk A&D, that extreme overbought reading. Bias, neutral to maybe a bearish tilt, but expect high volatility. Confidence here is only medium because of the conflicting forces and heavy speculation.
What really stands out there, and maybe this is another aha moment about how markets work, is how just one single piece of new, unpredictable information, this court ruling, can completely change the odds you thought you had based on weeks of prior data.
Exactly.
It just shows the sheer speed at which markets adapt and reprioritize when a fundamental assumption like, basic policy stability gets thrown out the window.
It forces that rapid rethink, absolutely. Yeah. A rapid shift in strategy.
So, given this updated picture, prioritizing that tariff risk based on the sources, what does this mean for potential next steps? You mentioned the source material, outlined some scenarios, some potential action plans, focused on the next 24 or 48 hours.
And stressing risk management, right?
Absolutely stressing risk management.
Yeah.
This is a volatile setup. So based on the source's probability weighting and assessment, here are the potential action plans, summarized by the primary lean for each stock. For NVDA, primary lean is bearish, 70% probability suggested. The plan outlined is, consider shorting if it breaks below 133 pounds. Targets are 128 cents, then $124.90. Stop loss zone suggested above $141. Rationale. Overbought plus the new tariff trigger increases pullback odds.
Okay. Apple.
AAPL, primary lean, strongly bearish, 80% probability. Action. Consider shorting on a break below $198.00. Targets, $195, $192, 190 cents. Stop zone above $202. Rationale. High tariff sensitivity, already weak technicals.
Key AR, primary lean, bearish, 60% probability. Action. Consider shorting on break below $68.50. Targets, $66, $63.50. Stop zone above $71.50. Rationale. New tariffs directly test their previous mitigation claims.
No, it's corny.
OC, primary lean, bearish, also 60%. Action. Consider shorting on break below $132. Targets, $128, $125. Stop zone above $137. Rationale. Similar to carrier construction related, facing a test of tariff mitigation in a possibly slowing economy.
And U.S. steel, the wild card.
Primary lean is neutral to bearish, high volatility, bearish scenario pegged at 55% probability. The bearish action plan. Consider shorting if it fails to hold $52 and the RSI drops significantly. Targets $49.47, stop zone above $54.50. However, the source also includes a highly speculative bullish action plan. Only consider buying if there's a strong break above $54 with heavy volume, driven by a clear steel protectionism narrative. Targets $57, $60. Tight stop suggested below $51. The source heavily caveats this bullish trade as very high risk.
Yeah, that emphasis on stop losses feels absolutely critical here, especially with X, given that volatility. when policy news hits, things can gap violently.
Couldn't agree more. The overall strategy suggested by the sources, it's defensive. Focus on preserving capital right now. If you are looking for trades, the higher probability ones align with this dominant tariff uncertainty theme, usually meaning bearish setups on exposed names, and monitor everything. The news flow constantly, the VIX for fear spikes, options activity like put-call ratios for sentiment shifts.
Okay, let's just push a bit deeper before we wrap. Beyond the immediate price moves, what about second-order effects? Less obvious consequences the sources mentioned for these companies or sectors from these tariffs?
Yeah, good question. For Nvidia, it's not just the China sales number. It's potential disruption to their incredibly complex global supply chain for components that could delay or raise costs for future products like Blackwell. Also, a broader global slowdown from tariffs could eventually hit overall IT spending by businesses. The counterargument some sources raise, though, is that this might actually accelerate sovereign AI pushes by governments wanting their own AI infrastructure, which could be a long-term positive for Nvidia.
Interesting. Okay. Apple.
For AAPL, if they do pass on significant tariff costs via higher iPhone prices globally, that could really accelerate Android grabbing market share, especially in price-sensitive emerging markets. And any major push towards U.S. manufacturing fundamentally rewrites their entire cost structure. Big changes.
Right. Industrials like BARR and OC.
For car and OC, if these tariffs stick around, it could genuinely push them and their suppliers towards more reshoring or nearshoring of manufacturing. That's expensive and messy short term, but maybe builds more resilient supply chains long term. Could also spur innovation, finding ways around tariffed materials. But for OC specifically, any tariff-induced economic slowdown is a direct hit to construction demand.
And U.S. Steel.
For X, well, retaliation is a risk. Other countries hitting U.S. exports with their own tariffs, the Nippon Steel deal, could face even more political static in this climate. And there's a risk that if these tariffs feel like just short-term politics, the long-term domestic investment needed to truly revive the U.S. steel industry might not actually happen.
This brings up a really important question, circling back to you, the listener. How does this kind of environment where major policy can just shift on a dime, totally unexpectedly, how does that change your own approach, your own strategy for investing?
It really throws a spotlight on that strategic misalignment we're seeing right now. You've got these genuinely strong company stories, Nvidia's AI lead, solid earnings from EAR and OC crashing right into this incredibly uncertain, maybe deteriorating macro picture driven entirely by trade policy shifts. So your short-term strategy might need to, well, prioritize managing that macro risk over its focusing on the company fundamentals. Or maybe look at trades designed specifically for volatility. The fact that the source material ranks bearish setups on these tariff-exposed stocks as higher probability right now, that reflects the judgment that this new wave of policy uncertainty is the dominant downward force, at least for the immediate future.
So there you have it. We've taken a deep dive, tried to cut through the noise in the sources you shared, really focusing on this unexpected return of global tariffs and what it could mean for the market and these key stocks.
And the core message from that material seems pretty stark, that tariff reinstatement. It's the dominant driver right now. It injects massive uncertainty, creates a cautious, maybe even bearish short-term outlook, and it's overriding some of those positive signals we saw earlier from earnings and economic data. Policy stability is just huge for market confidence. And right now, that stability feels like it's taken a major hit.
So here's a final thought for you to chew on. In an environment where government policy can pivot so fast with such unpredictable results, how much volatility, how much uncertainty are you really comfortable navigating? And what does that realization mean for how you decide to position yourself in these very deep and choppy waters? For the fastest, most frequent updates on how these stories keep developing, because you know they will, and what it all means for the market, make sure you subscribe right here to The Deep Dive.